Welcome, guys. Thank you for joining in. I know this is a very exciting session for the options traders out there. You're wanting to know some more details around the Greeks. We talk about these in the seminar, and I want to just give you guys a quick overview as to what they're used for and how they can benefit you with options trading. All right. Okay, guys. Well, they are used primarily to help ensure that you're getting an options, getting into a contract that you can make money off of, all right? There are about four uh, Greeks that I'm going to cover here, and I want to talk about them briefly in this learning opportunity here. The first one is delta, guys. Now, delta is the market's expectation that that contract will expire in the money. Now, for example, if that delta value is 60, that means the market has assessed contract and assessed where the underlying security is and say, hey, on that date, we think there's a 60% chance that that price will be achieved and you will expire in the money. So a 60 would be a 60%. So it also, just measures the sensitivity of the options premium along with the stock price as well. You guys may have noticed some premiums on some stock prices are way more expensive relatively to the cost of the stock itself than other premiums where the stock price is the same. Right? For example, company A can have a stock price of $13. Company B can have a stock price of $13. If you go to the options opportunities for those two stocks, the premiums for those opportunities for those contracts are drastically different. Well, delta has a lot to do with that. And it's because of the market's assessment on whether or not that contract or that company is going to do, make the stock price reach the stock price in which you're assuming it's going to reach when you do that options contract. Okay? Gamma is another Greek. The value in gamma increases as you get closer to in the money. So when you guys go out and start looking at options contracts, you see gamma, the higher it is, the closer you are to being in the money. Okay. Theta. Think of time when you think of theta. The further it goes out, is how the price will change for that particular options contract, okay? And Vega, the volatility. When you think of Vega, think of volatility. The more volatile the underlying asset is, the more expensive the stock contract is going to be. For example, if you're living in the Memphis area, and we know this is on the pneumatic fault line, and you're trying to get earthquake insurance, well, in Memphis, that earthquake insurance is going to be very volatile. It's going to be more expensive than it would be somewhere in Kansas where there's no chance of an earthquake at all. So in other words, in Kansas, the volatility is low. In Memphis, it's high. What am I saying? The more volatile that price of that stock is going to be, the more expensive that contract is going to be. So you're able to read all of these Greeks. If you have the tools, in my advanced options class, we talk about all of these tools. We talk about how to set these tools up and be able to view these tools as well. So if you have not done the advanced options class, definitely take a look at those opportunities, either in the online recorded webinar or the live seminar. All can be found at reserve.simerinvestments.com. Well, that's the end of this one. I hope this serves as a benefit to you guys as you are continuing to learn this options trading stuff. Thank you.